Powell said during the press conference very clearly they were going to go.
Bitcoin certainly did not like the relatively hawkish FOMC minutes that came out earlier today, my time. Longer term, though, we still think good prospects for that asset.
On the issue of Mr. Djokovic, rules are rules. And there are no special cases.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Hawks out in full force. Fed minutes signal more aggressive rate hikes than expected. Tech sells off, and the Treasury round picks up steam. European stocks drop at the open. Plus, we'll talk to the Natwest Chairman, Howard Davies, about inflation, growth, and the future of banking. The markets, let's have a quick look at the markets, because if you look at the European stocks, they're down some 1.2%, so not the rout yesterday that we saw on the back of those Fed minutes. Still something that we need to keep an eye on, especially technology. This is after the Fed said that they would hike more aggressively, possibly. That came from the December meeting of the minutes. Not only more aggressively, but they could start earlier than expected. Some think it's the markets getting ahead of themselves or panicking for nothing. Others actually taking some huge, large positioning. I would say professionals really changing some of the game in that. The U.S. 10-year yield, 172.81. My chart of the hour is actually the correlation between treasuries and what we're seeing in European stocks. So that will be a very interesting one to see the way forward. After we saw the sell-off overall yesterday, the S&P futures are a little bit more quiet, I would say, a little bit more acquiescent. Right. This is the Capitol, 1 year anniversary of the riots. January 6, 2021 was a big day, of course, in U.S. politics. So we'll have a look at what that means overall for that. But the other thing I want to show you, I hope we have it, otherwise we'll go on to the markets in general, is what the European map is doing. A lot of red on the screen. Again, the Federal Reserve signaling that interest rate hikes may be more aggressive. We saw this sell-off in Chinese companies that accelerated. And I have to say, the hammering in tech stocks that began to spread into the broader market, now being fueled by one of the most intense bouts of selling by professional speculators since the financial crisis. And that's all over the European market. My chart of the hour, I love this. I have to thank our queen of charts, Valerie, for bringing this to my attention. And it's really the fact that if we look at repricing some of the Treasury yields, and we're seeing as the MSCI Europe Value Index versus the U.S. 10-year Treasury yield, which is the one that you have in blue here. And look at that green box right at the end of the screen. If you look at the outperformance that we are trying to predict for 2022, European stocks, because they're more correlated to Treasuries than other parts of the world, actually could see them go higher than other parts of the world. This is also because of the valuation over the last 24 months or so. Big moves in general. This morning, investors digesting the Fed's indication of more aggressive policy tightening. Here's how some of the leading industry voices have been interpreting the latest FOMC minutes.
Powell said during the press conference very clearly they were going to go.
Is this a meaningful shift to the place where the Federal Reserve is going to raise interest rates so rapidly?
I don't think that they'll be as hawkish as they were in December. And remember, this is just the Fed talking.
What's changed in terms of the Fed's reaction function?
This is the early stages of a tightening cycle. And as we know, it's usually not the first rate hike that matters. It's usually the last one.
A few hikes with real rates still being quite low and likely to remain quite low is still a broadly accommodative backdrop.
March is a live meeting for hikes. I think the only surprise, perhaps, was sort of the view on the balance sheet runoff.
We should expect volatility to return to markets when we get unexpected results out of central bankers.
You're seeing orderly volatility in the marketplace because the Fed has signaled pretty significantly about their tapering plans.
So let's get into the key market drivers with our markets editor, Christine Aquino. Christine, it's partly what the Fed did in terms of the minutes, but also we just have encouraging news out of the U.S. economy.
Absolutely, Francine. And I think all of these catalysts are really creating some very interesting divergences within markets today. You know, I think it was really interesting what you were highlighting in your chart earlier, that really this higher Treasury yield environment is very much right for an environment for European value stocks to shine. And we're definitely seeing some views coming out already that the pain that we're seeing in U.S. tech stocks and some of those higher froth, higher growth stocks is the gain that equities could capitalize on here in Europe for sure.
Christine, what you're very good at is looking at some of these market moves that maybe other people didn't see. Is 2022 going to be more difficult to make money overall? So do you have to find these almost idiosyncratic stories?
Absolutely, Francine. I think that's exactly the theme for this year, because even though we have this broad story of central bank tightening, we do definitely have those pockets of idiosyncrasies, for instance. And so I think the key for investors heading into this year is really trying to spot those divergences. Already this morning, we're seeing some of that playing out in the FX markets. For instance, the divergence between the Japanese yen and the Swiss franc definitely catching our eye this morning, because we're seeing the yen rallying even as the Swissy on the back foot today. And really it digs down to the question of, where's the froth, where's the value, and where is there still room for investors to be able to make money?
Yeah, that little question of where's the froth, because you could lose trillions actually if you bet that wrong. Christine, thank you so much. Christine Aquino there, our markets editor. Now we're also joined by Ed Ching, Chief Investment Officer at BNP Paribas Wealth Management. Ed, happy 2022. Where do you see the froth?
Where do I see the froth? Well, I see the froth where retail investors are. And where retail investors are, as we all know, is in US stocks, but particularly in US technology, large cap stocks. So I still see a little bit of froth there. And I do see the froth coming off, not just because of the performance of the NASDAQ Composite Index last night, is a reaction to the Fed minutes, but more importantly, what has been going on even before that. We believe or rather, the markets believe that tech is everything. However, when you look beneath the surface, companies such as Netflix or Amazon have actually already been tailing off for quite some time. And if you look at the smaller, non-profitable tech companies, we know that they've been performing really rather badly over the last few months. So actually, below the surface, the leadership of tech has been fading for quite some time and narrowing. And I believe that the rotation back towards cyclical value stocks, as you were mentioning earlier, is about to occur yet again.
Ed, I don't know if you've seen, I hope you've seen the movie Spinal Tap. I don't know if you're a fan, but it's part of my morning must read. So let me go straight to it, because it's a wonderful read by our John authors. And the piece is entitled The Fed Minutes That Shook the World. And in it, he basically says, look, last year was a really good one for risk assets in general and U.S. stocks in particular. We all know that, but just how good can we say it was? So John authors continues by saying, the last few days have been full of attempts to put 2021 into context. This may be too much deleted perspective, to quote Spinal Tap, but I think it's useful. What is the single biggest mistake that investors can do looking back?
Well, I think the biggest mistake they can make is assume that 2022 will be any sort of a repeat of 2021, either in terms of the scale of the performance in equities, or indeed in terms of the leadership, which stocks and which indices lead in 2022. Obviously, US and tech stocks have been leaders in 21. I don't believe the US or tech stocks will lead in 22. So I think that's the first point. I think the second point is that we absolutely are entering a more difficult period for equities. That does not mean that they can't go up. In fact, around the first rate hike of the Fed, if you look at the last 7 cycles, equities have done very well in the lead up to the rate hike and for 6 months after the first rate hike. So if we assume, and our house view is that the first rate hike still comes in June, yes, there is maybe a risk it comes a little bit earlier, but let's stick with June for now. Well, that means that in the lead up to June, equities could still post positive performance, and up until the end of the year, they could continue to do quite well. Maybe not the 28% total return of the S&P last year, but still modest positive returns, I think, are in prospect this year for equity markets.
Ed, this is my chart of the hour. I love this chart because it talks about, the Fed and some of the repricing in treasuries, but actually the correlation between treasuries and European stocks, certainly value stocks. Do you take advantage of it?
Oh, I love that. I've been pushing European cyclical value stocks for some time. The two sectors, and it's worked. To be honest, last year was a very good year, as we know, for financial sectors. And the key sectors to benefit from the steepening of the yield curve in the repricing of the bond market are the financial sectors, banks and life insurance. And I focus on life insurance because, again, they can typically offer better premium yields on new savings products. So that tends to attract new money, and that tends to be the biggest driver for the life insurance market. And of course, banks tend to benefit as well. Although when I talk to a banks analyst, they can never really explain to me exactly why banks do well out of a higher yield. They come up with all sorts of explanations, but there's no real obvious explanation overall. Nevertheless, that's what we see. That is the correlation. And as we know, banks, both in terms of cash flow results and balance sheets, are looking very healthy today compared to where they were a year, 2 years, or 3 years ago. So certainly that is one of my favored sectors, particularly in Europe.
Okay, interesting. Thanks so much, Ed. I mean, intuitively, higher interest rates means that at least there's no negative rates, which is a boost for banks. Ed Ching, their Chief Investment Officer at BNP Paribas Wealth Management, stays with us, and we'll have plenty more conversations on some of the tech valuations as well. Then, coming up later in the show, we'll talk to the Natwest Chairman, Howard Davies, about inflation growth and the future of banking. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg. First word news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Italy is to make jabs compulsory for people over 50 and will further reduce what unvaccinated people can do. That's after COVID cases rose to record levels. Meanwhile, President Emmanuel Macron is under pressure after France suffered Europe's highest ever daily count of infections yesterday, with more than 330,000 cases. Now, North Korea says a test fired a hypersonic missile yesterday as it continues to develop strategic weapons in a challenge to the US and its allies. State media says the missile precisely hit a target more than 430 miles away. The test comes days after leader Kim Jong-un indicated nuclear talks with the US were a low priority for Pyongyang. And lawyers for Novak Djokovic have mounted a legal challenge against Australia's decision to deport the world #1 tennis player. That is after federal officials overruled an earlier vaccine exemption for Djokovic. The Australian Border Force says he offered insufficient proof of vaccination to enter the country for the upcoming Grand Slam. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, we've had a bit of an update on Novak Djokovic. That appeal has been adjourned till Monday, so we do understand that the world #1 tennis player will be in quarantine in Melbourne, at least for the rest of the weekend.
Well, I mean, we understand that he's in a hotel. I hope he's watching Bloomberg in his hotel room. But really, what a fiasco. I mean, let him in and not. And it just goes to show some of the border control. If you don't have a united front, no matter what you think, Leanne, whether you should be vaccinated or not, it's messy.
Well, as the Prime Minister of Australia said, Scott Morrison, he did say, listen, rules are rules. We're not going to change them for whoever you are. We are sticking to our policy here in Australia. So as you say, Francine, what a fiasco. And I think we should tweet Djokovic to say, watch Francine and I on Bloomberg this morning.
And maybe come on to talk about what happened. Leanne, thank you so much. We'll have plenty more also on foreign affairs. Coming up, Russia sends troops to Kazakhstan to quell anti-government protests. Central Bank, meanwhile, temporarily halts financial market operations. We have the latest on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua. It's here in London. Apologies, an espresso too much. Now, Russia has dispatched troops to Kazakhstan to quell anti-government protests that have led the central bank to temporarily halt financial market operations. Now, protesters are angered by rising fuel prices and are calling for greater democracy in the country. Now, we're now joined by Wolfgang Munchau. He's director of Euro Intelligence. Wolfgang, I mean, Kazakhstan is not a country we speak about often, but this could have huge implications not only for uranium, but also the relationship between Russia and allies and the rest of this region.
Oh, absolutely. This is is a reminder that the borders around Russia and the former Soviet republics are still inherent, or many of them are still inherently unstable, and a sign of acute geopolitical tension. Russia sent troops into Kazakhstan this morning as part of the Collective Security Treaty Organization, which is a group of countries around Russia that have sent what they call a peacekeeping mission into Kazakhstan to quell the protests which have arisen over fuel. But there have been protests going on for a long time. The government is deeply unpopular, and this is a powder keg. And as you said, uranium is at stake here, and there's a lot, and it will possibly impact Ukraine too.
So what does it mean? I was going to ask you actually about the correlation with Ukraine. Does it embolden Russia to do something in Ukraine, and how would the international community then react to that?
I don't think it will sort of make it more or less likely for Russia to do what it wants to do over Ukraine. I still think that Russia Putin hasn't yet decided what to do in Ukraine. He is still pursuing a diplomatic effort, and it may well be that this diplomatic effort succeeds. I think the chances are probably not extremely strong, but certainly worth pursuing. But he has, the troop movements. It's not just troop movements. He really has built up, really prepared for war in a very serious way, and in a way that cannot be sustained. Either he has to go in or go out. He has a few weeks. And that would be, the end of January would probably be the moment, or mid-end January would probably be the moment when things come to a head. But I don't think that Kazakhstan emboldens him, but it emboldens his vision that the Russian security, in a wider sense, is under threat. That's the story he's been telling us, himself and the rest of the world, that Russia is under threat. The West is threatening Russia, which is not true objectively, but it's a narrative that he has been peddling, and that is widely believed in Russia. So that the Kazakhstan situation underlines that.
Yeah, I mean, the enormity, right, of a possible Russia invasion in Ukraine. I mean, something that was really unthinkable about 7-8 years ago. Does the international community do something about it, or has it now been normalized because we talk about it so much?
I fear that too. I fear that there's a degree of normalization. In Germany, I'm hearing politicians saying that if that happens, we would need to step up the dialogue with Russia. So there is certainly no willingness to confront Russia. Then, some people in the German government are talking about maybe this will, delay Nord Stream 2. But the willingness of the EU to stand up to Russia in a serious sense is highly limited. We're not going to cut off gas supplies in the middle of the winter. We have made ourselves dependent on Russian energy. There's only so much we can do. We cannot cut them off the SWIFT payment system, because that's how we pay for our gas. So there will be, whenever you come up with a sort of catalog of sanctions, there will always be somebody who raises their finger and says, oh, we can't do that because, our own interests are at stake. And since we've already, ruled out any military intervention, from the outset, that has clearly emboldened him, and he perceives the West as weak. He certainly perceives the EU as weak, and I can't blame him for that. And he will now pursue his agenda. It will be a disaster for Russia in the long run. I have no doubt about that. Right. But it doesn't mean it's not going to happen.
Wolfgang, in France, the pandemic has also become a live political issue. I mean, it's been for a long time, but now President Macron is really under pressure after the country suffered Europe's highest ever daily number of cases yesterday, with more than 330,000 cases. And then that pretty explosive, and I have to say expletive, also interview in Le Parisien, where he says, the government's vaccination strategy is to hassle, that's putting it mildly, people who hadn't taken the coronavirus shot. I mean, how much of a gamble is this 6 months from a presidential election?
I think it's an unnecessary gamble because he doesn't need to gamble that high. He has a solid lead in the polls, and all he needs to do is be the president and wait until his opponents self-destruct. That's certainly one strategy I would advise him to take. But taking these extreme words, he's used an expletive, which I'm not going to translate, and he certainly said that the anti-vaxxers should be deprived, or are no citizens. So basically questioning a person's citizenship is a fairly high act. I mean, it goes against all European, rules and laws, and we have, charters of human rights that you can't do that. But it's a political statement, obviously not something he's actually going to do. But it shows that, and it shows an extremism in language that might be responded to with other forms of extremism on the right.
Yeah, I mean, is it extremist, or is his weakness that he's perceived as being arrogant, and how does that play out in the vote?
I think that's right. He's arrogant and also impulsive. And it doesn't sound very presidential what he did. This is not something you would expect a president to do. And that's the biggest weakness. His opponents can now easily say, look, we agree with him on the substance, but it's absolutely unnecessary for a president to use those highly provocative terms. And there's sort of an element of instability in this man that people have doubts over. And he's raised those doubts. So that's what I think is, it's an impulsiveness that I would think is probably the biggest weakness of Macron.
Wolfgang, thanks so much. Wolfgang Munchau, the Director of Euro-Intelligence, and we'll have to get you back also to talk about Italy, because we could see a new president, and it could mean also a new prime minister. Coming up, we talk Fed, Bank of England, and COVID with the chairman of NatWest, Sir Howard Davies. This is Bloomberg. Hawks out in full force. Fed minutes signal more aggressive rate hikes than expected. Tech sells off and the Treasury rout picks up steam. European stocks drop at the open. And we talk to the NatWest Chairman, Howard Davies, about inflation, growth, and the future of banking very, very shortly. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the market, I guess, is, falling out of bed less than it was about 15 minutes ago, but still significant pressure on a lot of the technology stocks. If you look at the European stocks, 600 down over 1%. Now, the focus is not only on technology, but also the great rotation that we've been talking about. And the other question is what happens with technology shares. So we did see the rout also in bonds accelerating after the Fed signal interest rate hikes that may be more aggressive than many had expected. And the other thing that was brought to my attention is the hammering in tech stocks that then began to spread into the broader market, also being fueled by one of the most intense bouts of selling by professional speculators since the financial crisis. So it's a new year. Is it a new Fed? Well, minutes from December's FOMC meeting showed Fed officials considered earlier and faster rate hikes than expected, with U.S. inflation continuing to rise. Some board members also called for reducing the central bank's balance sheet relatively soon after beginning to raise the federal funds rate. Well, we're now joined by Sir Howard Davies. He's chairman of NatWest Group, professional, of course, of financial regulation and central banking at Sciences Po. He also has been director of the London School of Economics and served as chairman of the UK Financial Service Authority, was also deputy governor of the Bank of England. So he has a good global round view of the world. Sir Howard, as always, thank you so much for getting us started on some of the pitfalls that we could see in 2022. The market seems to be focusing on the Fed hiking a lot, but does that go hand in hand with a stronger economy, which we're starting to see, especially in the US? And is that something that we should be looking forward to instead of looking at the negative of policy accommodation?
Yeah, well, perhaps I should start by saying Happy New Year to you and to your viewers, because I think after that might be the happiest thing I say. I mean, I do think we're in a difficult period at the moment. I mean, the central banks, particularly the Fed and the Bank of England, are playing catch up, I think, because many of us, and certainly I was one, thought that they were reacting too slowly to the rise in inflation, and that the inflation was now having a second round characteristics. In other words, you were starting to see it feed into labor market behavior. It wasn't just a commodity price problem. And so now we're seeing probably signs that what people forecast, which is that if they start late on tightening, they'll have to do more. It looks as if that's now what's going to happen. And so we've got a classic sort of late adjustment in the cycle where the Fed is now saying, well, things have got more serious than we had hoped they would be, so we're probably going to have to do more rises. And I think the market today and yesterday is trying to adjust to that new prospect.
Are they doing it in a rational way? Or is the market, we're going to see a lot more volatility in 2022, and does that translate into the real economy? Are banks going to be once again under pressure?
I don't think that banks are going to be that much under pressure, but I mean, it could be that there are more impairments, but I wouldn't be expecting that at this point. And I think that conventionally, of course, banks benefit from higher interest rates. You know, the spread tends to widen if interest rates are at a higher level. So what you've seen in the UK, in fact, is quite good performance by UK bank stocks recently, because people are saying, well, you know, the rates are going to be somewhat higher than we forecast, and the banks will have slightly higher margins and slightly higher profits as a result. So I don't think it's a bank problem, not that I see at this point. You're always reluctant as the bank chairman to say things are fine, but I mean, I'm not seeing that issue. So I think it's more whether they will have to jump more than the market wants. Now, you asked specifically, are they doing it the right way? Well, I think the conventional wisdom would have been that they should have tapered their purchases more earlier, withdrawn from the market's quantitative easing to a greater degree, and then begin the rise in interest rates. Now, they didn't do that because they didn't want to react. And until quite recently, of course, the Fed was saying, you know, move along, nothing to see here. So that they're left now with a very large balance sheet, but they're also starting to raise interest rates. So I don't think that is the ideal sequencing. But of course, we've never been in this situation before with Fed balance sheets of this scale. So it's very hard to say that there's a school solution here.
Sir Howard, what's your take on inflation in the UK? So we had a poll suggesting that a record number of UK businesses are worried about inflation and are also expecting to raise their own prices.
Yes, well, I do find it quite worrying in the UK because we've got a peculiar labour market with a lot of vacancies. A lot of people have left the labour market, but it appears many of them not coming back. So it's older workers who have left and probably will not be bidding for those jobs. So we do have some labour market pressures. And of course, we've got import price increases, and you know we're subject to commodities like everybody else. So I do think that there is going to be a further rise in inflation here. And there's quite a lot of indexation in pensions and things like that, which actually adds to the mix. And of course, we've got the big energy price adjustments coming fairly soon, we think.
So is the bank seeing customers struggle with these price increases for energy? And is there anything that banks can do to actually help with that?
Not yet, really, because mostly the prices haven't risen sharply. I mean, the problems that people are facing at the moment is that quite a few of the energy suppliers who came into the market are going out of the market, as we can see, going bankrupt. So people are there's a lot of market disruption in the retail end, with people having to change their supplier. But we haven't yet seen pressure on people as a result of price increases. And I have to say, at the moment, I mean, on average, you know, consumers are still fairly cash rich. You know, deposits are not growing like they used to last year, but there's a lot of bank deposits. But of course, the problem that politicians will face is that there will be some people at the bottom end of the distribution, or in particularly affected houses, who will be significantly affected when these price rises come. So there are two issues really. One is, you know, is there anything that you can do to keep these energy suppliers in business for a while? And you know, maybe there's some case for doing that, but I think that would have to be a national scheme. I don't think individual banks can really sort that problem out their own. And then there's the question of what you do to the consumers who are particularly badly affected, people on benefits, who are going to face a significant increase in their energy prices. That's a different question. I don't think that's a bank issue.
So what are you seeing from customers right now? We're in the middle of a pandemic. We had a record number of cases. I don't also know whether, for example, COVID means that you have a lot of staff off, and so it's difficult to keep operations running in certain parts of the world. But as a bank chair, how are you seeing the UK economy develop?
Well, from the from the individual bank's perspective, yeah, we do have more people off sick, and something like 20% of the branch staff are currently off, largely self-isolating and not largely actually ill. And so that's a bit of a challenge, but we have been able to keep functions going. I mean, keep our branches open, keep our services going. But, people will maybe notice a bit of a shortage, but I don't think we're differently affected from anywhere else in the economy. So there's that point. Otherwise, things are, it's very patchy. I mean, the hospitality sector obviously has had a very rough time. The travel sector has had a very rough time, and we are seeing signs of strain in some of those businesses, undoubtedly. But the economy as a whole, people have learnt to live with lockdowns to a much greater degree than they used to. So if you look at the economic impact of the different types of measures that the government have taken, from the first lockdown in early 2020 onwards, the economic impact of each of them has been lesser as you've gone along, as people have found workarounds. And so I think at the moment what you're seeing is just a small part of the economy, I mean a significant one, but not massive, of hospitality, travel, etc., and inner city retail, where people are just not going, and that's in trouble. The economy as a whole is not.
Okay, Sir Howard, thanks so much. Sir Howard Davies, the chairman of Natwest Group, stays with us. My two key questions to you, Sir Howard, will be, first of all, the return to the office, whether we get the mix right, and of course, what are your gains and losses for financial services a year from Brexit? So we'll talk a little bit about Brexit, and we'll talk a lot more about what 2022 has in hold for banks and employers. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Standard Chartered and UBS are tightening virus restrictions at their Hong Kong offices. Both banks will move to split their workforces into teams, which will alternate office work on a week-to-week basis. The new curbs follow Hong Kong's move to tighten social distancing measures amid a rise in local infections. Now, Amazon is teaming up with car maker Stellantis to develop software and buy electric delivery vans. The move pits a European auto company against US startup Rivian in supplying EVs for the world's biggest e-commerce company. And Toshiba's second biggest investor has called for a special shareholder meeting as it steps up opposition to the Japanese firm's breakup plans. Toshiba said in November it intended to separate into three companies after years of corporate governance issues. Singapore-based 3D Investment Partners is requesting a 2/3 vote on the proposed split before it does go ahead. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, still with us for a good conversation on banking, but also the economy, the UK and worldwide, is Sir Howard Davies. He's chairman of Natwest Group. Sir Howard, thank you so much for sticking around. When you look at the UK economy, we're just at the beginning of 2022. What's your biggest concern? What's your biggest worry of what we'll face in the next 12 months?
Well, I think my biggest worry is whether the government can stabilize the public finances. And we seem to have lost sight of that we've got through COVID with massive increases in government spending, some of it absolutely inevitable on the health service, but also lots of support for business. And the government said, well, OK, we'll do that. It's rational, and I would support that, and I agree it. But, of course, we will, in due course, need to stabilize the public finances because you can't have public debt to GDP ratios going up and up and up. And so their key measure for that was the health and social care levy. At least that's the start of it. And also, of course, increases in corporation tax along the line. You wouldn't expect me to put a flag to welcome those, but I understand why they're doing it. But we've now seen stories, from the Financial Times, I don't know if it's absolutely true or not, but that there's a dispute in the government about whether they should go ahead with the health and social care. Now, that strikes me as being a worrying development, because if a government sets out a clear fiscal strategy, gets it voted through the House, and then a couple of months before it's arguing about whether it should do that or not, that's worrying, not just because of the amount of money involved, but also because of what it tells you about, the confidence and the clarity of the government strategy. So I've got to say, I think that's my biggest single worry at the moment.
Yeah. So you're worried that what this flip-flopping or this not so much clarity for investors could lead to outside investor appetite diminishing for the UK, or what's the worst case scenario?
Well, it would put pressure on the long end of the yield curve, because it would put pressure on people thinking, well, if the government isn't going to be able to stabilise the finances, if they don't have a solid majority for doing that, then government borrowing is going to be much higher than we thought. And in that case, we're going to be worried about the rates at which they borrow. So you could see a steepening of the yield curve, and that, of course, in turn feeds into the debt interest line of the government's expenditure and makes life even harder for them. So I think this is a delicate thing, and I think it's why the Treasury, as we understand it, are holding firm and saying, no, we've got to do this, because that's the prospectus we've put before the market, a kind of gradual stabilisation of the government's balance sheet, and we must stick to that. I very much hope they do, but it's very worrying if there are, core elements of the government who don't believe in it.
A year after Brexit, what has financial services gained and lost?
Gain is a tough one. Let me come back to that. As for lost, well, the job moves out of London have been significantly smaller than some forecast. Now, the reasons for that are a little bit difficult to be certain about. Part of it, I think, is actually COVID, because it's actually difficult to move people, as you know. But also it's because the European Union and the European Commission have been prepared to grant some exemptions for clearing in London, where they've extended the time with which people can use the London clearing system, which at one point they were saying was going to have to move back into the Eurozone. So there have been various things that have happened that have sort of slowed moves to continental Europe. As for where that goes in the future, very difficult to tell. There's quite a lot of tension within the EU and the Eurozone, because they would like to pull back, the ECB and the Commission would like to pull back activity into the Eurozone. But the banks are saying, well, just a minute, what is the infrastructure that we would then use if we did pull business back? So there's quite a lot of tension, very difficult to forecast how it will go. But I still expect there to be further moves of activity into the Eurozone, where it's European banks dealing with European clients in particular.
So from a regulation point of view, Sir Howard, what would be your top of your wish list on what we could get in the next couple of years, and the city's wish list?
Top of my wish list would be nothing. In other words, would be stability in the capital regime. I think that the recapitalization of the banking system that occurred after the great financial crisis, which has been on a substantial scale, we've now seen a real-life stress test in the form of the COVID crisis, and the banking system on the whole has come through that reasonably well. The banks remained open for business, there was no credit crunch, the banks remained decently capitalized, and so I think that, to me, says that the new balance of capital in the banking system has been quite well calibrated.
Right.
And so I would like to see that just stay, and let's have some stability for a while. And there are still talks at Basel about further changes, the bank's called Basel IV. I'm not sure the case for that's been made out, and I would therefore argue strongly for nothing.
Sir Howard, on the return to the office, NatWest actually adopted a pretty flexible model last year. Are you happy with the way it's going?
Well, it's going where the government sort of allows it to go, you see what I mean, in that we were, in the run-up to Christmas, on a gradual tack of bringing people back to the office. I mean, in a carefully managed way of teams coming in at different times and, making sure that there was testing available, etc. All of that was moving quite sensibly up to early December, when, of course, with the Omicron variant arriving, the advice from the government changed. So that's been, I would say, more or less put on hold. So we have some people coming into the office, and people are able to do lateral flow tests when they do it and all that. But that is certainly on pause. Honestly, I think we'll just have to wait and see how the guidance evolves. We would like to get more people back into the office because I do think that's a better way of working, not all the time. It will go back to the way it was before. But at the moment, we're on hold, bluntly.
Yeah, like many companies, of course, here in the UK. Sir Howard, thank you, as always, for all of your insights. Sir Howard Davies there, the chairman of Natwest Group. Now, coming up, today marks also the one-year anniversary of the riots in Washington, so we'll get the latest as DC gets set to market. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, President Biden will mark 1 year since the deadly Capitol insurrection by seeking to rally Democrats around voting right legislation. He also warned that inaction risks emboldening extremist followers of former President Donald Trump before the midterm elections, while Biden and his allies in Congress plan a full slate of events today marking the January 6th riots. Joining us now for more is our executive editor for international government, Rosalind Matheson. Ros, thank you so much for joining us. What exactly are you expecting today?
Well, as you were saying, there's a full slate of events today. The US President Joe Biden is going to speak this morning to lawmakers, as will the House Speaker Nancy Pelosi. Congress is not in session, but lawmakers will be there, and there'll be a moment of silence, and there'll be a prayer vigil on the steps of the Capitol later today. The conversation from the Democrats is going to be very much centered around what it means at the moment for the state of American democracy. How can that be safeguarded, and so on. So security will be very tight, of course, there, but should be some crowds at least around the Capitol. The interesting thing is that the Republicans seem to be laying very low. There are no key events scheduled on the Republican side. Some of them are actually out of town. And of course, in the most notable one, the former US President Donald Trump had scheduled a media briefing today at his resort in Florida, where he was going to again rebut make his claims that the 2020 election was stolen. Of course, that's been disputed, but he's decided to cancel that at the last minute and also lay low. So there's nothing much from that side at all today.
So, Ross, how, if at all, does this factor into the midterm elections?
Well, that's the key, because Donald Trump, of course, while being quiet today, has behind the scenes been very busy backing certain Republican candidates and saying very much to the GOP and to voters, if you're not with me, you're against me. And he's singling out potential candidates around the country already and saying, I'm going to throw my weight behind you, or I'm actively going to work against you. So that very much will play into the midterms. But really, the focus is on President Joe Biden and what he can do at this point to reclaim his popularity. The recent polling has shown that he's polling around 40%, which is definitely on the low side, and he's really struggling to get the main part of his economic agenda through Congress. And if that bleeds on for several more weeks, it really starts to seep into the campaigning for the midterms. He's being seen as a president then who cannot get stuff done. Of course, the pandemic is still raging across the country, and it's affecting the healthcare centre and alike. And so that's really going to sap the energy for his campaign and the Democrats. And if you don't have the Democrats united, if they're still arguing about the economic package, then how are they going to work together in terms of the congressional races? So that's a real challenge for him.
Ros, thank you so much. Our executive editor there for international government, Rosalind Matheson. The hammering in tech stocks continues. It is spreading also into the broader market. So more Bloomberg Surveillance next.
What's changed in terms of the Fed's reaction function?
This is the early stages of a tightening cycle. And as we know, it's usually not the first rate hike that matters. It's usually the last one.
A few hikes with real rates still being quite low and likely to remain quite low is still a broadly accommodative backdrop.
You're seeing orderly volatility in the marketplace because the Fed has signaled pretty significantly about their tapering plans.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, January 6th. Our top stories today. Fallout from the Fed. The central bank indicates it will be more aggressive when it comes to policy tightening. European stocks are lower, but the sell-off in U.S. equity futures subsides. 1 year after the attack on the Capitol, President Biden's expected to put the blame on Donald Trump as he marks the anniversary of the insurrection. And Russian troops will head to Kazakhstan. They'll try to quell the protests that are the biggest threat to the country's leadership in decades. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards with Danny Berger in London. Kailey Leinz is in New York with us. Matt Miller is off today. And Kailey, the post-Fed minutes reaction goes global. We see a sell-off in Asia stocks and European stocks.
Yeah, broadly a down day for risk assets and also a down day for bonds. So a 60-40 portfolio not doing too well over the last couple of days. As you said, that sell-off did continue in Asia. Broadly, it was a down day. The MSCI Asia Pacific Index closing in the red. Interestingly, Hong Kong was an outperformer. You saw a little bit of a rebound taking shape with the Hang Seng Tech Index, but tech dragged down Japanese stocks in particular lower. The Nikkei 225 ending the day down by almost 3 full percentage points. Its worst day since back in June. You also had Australian stocks posting their worst day since 2020. So it really was a down day for risk assets. And while Australian stocks were selling off, also that global bond sell-off came for Australian bonds. The 10-year yield up about 8 basis points. And finally, in FX, I would note the Japanese yen, the big outperformer in Asia and in G10, actually the only currency stronger against the dollar. It is trading at around 115.75, getting a little bit of a safe haven bid. Now, here in the U.S., as you alluded to, Anna, we are seeing futures off of session lows, but still they are in negative territory, specifically so for the NASDAQ 100. Those futures down about 0.2%, so underperforming yet again after the worst 2 days for that index, going all the way back to March of 2021. And of course, that is happening at the same time that bonds are at their highest since March of 2021. The 10-year yield up another 2 basis points today. We're trading at 172 about that level. So those higher yields really calling into question some of those richly valued equities. Finally, in commodities, I would note WTI crude climbing for a fourth day. We are north of $78 a barrel, but not so great for Bitcoin, Danny. Bitcoin falling further and further below that record high. We're now sub $43,000, down about 36% from that all-time high hit in November.
There really aren't that many places to look for safety in this market at the moment. Europe certainly isn't one of them, falling this morning just after hitting all-time highs yesterday. And this is notable considering that from the sell side, analyst after analyst has said Europe should be safer from higher yields. Goldman said this, Otto said this. We also heard from Bernstein and Citi. So a lot of opinions there that the red picture we're seeing is not going to last. Still, most of these regional indexes falling more than 1%. Again, despite the fact that these tend to be shorter duration equities, shouldn't be as hard hit when it comes to the bond moves. Still, we're looking at the biggest drop for the Stock 600 since December 20th. That all really is predicated not just on the U.S. bond move, but European bond moves as well. We're also looking at European bonds selling off in Europe. German bunds at a negative 6 basis points. We are the closest to zero since May 2019 with a move higher of 2 basis points this morning. UK yields, though, leading the underperformance. Those are moving higher by 4 years for your 10-year gilt yield. That's at 113. So this picture is then influencing what's happening underneath the surface. It is this rotation that we continue to see yesterday into today. Yes, every sector in the Stock 600 is negative today. However, the worst performing sector is tech, similar to the U.S., those longer duration equities down 2.4%. The best performer, Anna, is banks. It is flat, slightly lower, less than 0.1%, but that really is quite the accomplishment on such an ugly day.
Yeah, on such an ugly day, perhaps that is one of the few sectors that, you know, can find the silver lining in the higher yield environment, or one of a few. Danny, let's take a look at some of the things that lie ahead for us today, things on our agenda. And of course, we start with some politics. U.S. House Speaker Nancy Pelosi plans to observe the 1-year anniversary of the attacks at Capitol Hill. Then St. Louis Fed President James Bullard discusses the U.S. economy and monetary policy during a virtual event hosted by the CFA Society of St. Louis. And we'll also get data out from the United States. US data, including initial jobless claims and trade balance as we go through the week and post the Fed. It will be interesting to see how the labor market comes to the fore once again. Strong ADP numbers, of course, yesterday. Let's get back to the Fed story then. Fed officials are preparing to move quicker than the last time they tightened monetary policy. This is to keep the US economy from overheating amid high inflation and near full employment. Let's get more with Bloomberg's Francine Lacqua. Francine, very good morning to you. I mean, the impact on markets of this increasingly hawkish pivot, more hawks at the Fed than perhaps had been anticipated, is really clear to see in global equities yesterday on Wall Street, today through Asia and into the European session. Has this markedly changed the market's thinking about how live the March meeting is, do you think?
I think so, Anna. I think, just looking at the pricing for the Fed meetings, for instance, we're definitely seeing a ramp up in those rate hike bets for the March meeting. Initially, I think markets were very much thinking May was going to be the first time that they were going to do it. But after what we heard from the Fed yesterday, I think they're starting to rethink this faster pace message from the Fed. And we're definitely seeing that reverberate across markets today. It's very much a sell everything sort of day in markets.
Well, you definitely have seen selling in treasuries, Christine. We ended 2021 around a 150. We are now north of 170 at the highest level since March of 2021. Is there any sign that this bond sell-off is overdone?
Well, Kailey, I think, this might just be kicking off because even before we heard from the Fed, we already saw some bets in the markets for 10-year Treasury yield hitting 1.95%, close to 2% by February. And so I think the message from the Fed overnight really just juices up that trade. And we're even starting to see investors coming out and saying we could potentially see 3%, which is way above the pain threshold that some strategists have highlighted for some of the higher growth sectors such as tech. And so, I think the message was heard loud and clear. We're definitely seeing that reverberate across markets today. And I think the next thing to watch out for is definitely the pace at which we could see those moves unfold, and also the pace of adjustment in terms of the market's expectations for how fast the Fed could go.
I think it was Mizuho that said we could see 3% on a 10-year yield. Definitely a big adjustment for markets. Christine, thanks so much. That's our Francine Lacqua. Now over to Washington, where President Biden will mark 1 year since the deadly Capitol insurrection by seeking to rally Democrats around voting rights legislation and warning that inaction risks emboldening extremists following former President Trump before the midterm elections. Jack Fitzpatrick, Bloomberg government reporter, joins us now. Jack, how compelling will this argument be that on the anniversary of January 6th, voting rights legislation needs to be passed?
Well, it's probably not going to be compelling enough to change the result in the Senate. Obviously, this is a message that the president and Democrats feel the need to send regardless. But they've made it clear they do expect Republican opposition in the upcoming votes on a couple election law measures that they plan to hold votes on. And that really makes the logistical question, the next big question in the Senate, what will happen in a subsequent expected vote to potentially change the Senate rules and maybe not entirely do away with the 60-vote threshold to end a filibuster, but to tweak it to require a talking filibuster. That's something Senate Democrats have gotten into, but really today I think there's the broader message and a focus on that broader issue in which the president is, one, looking to make it clear that he blames former President Donald Trump for what happened a year ago at the Capitol, and two, he connects that to issues around the country with state legislatures, in some cases, in Democrats' views, making it more difficult to vote, and believes that action in Congress is necessary to push back on that.
Well, and as you say, Jack, whether or not we'll get that action at this point is unclear. But let's talk about something that maybe could find some bipartisan consensus. I know you've been doing reporting on potential relief, fiscal aid for restaurants given the current COVID surge. What can you tell us about that?
Yeah, there are a couple senators on a bipartisan basis who have started talking about a bill in the near future. It may get pushed to next month, but it is in the works right now, that would provide some funds, particularly to restaurants. There may also be some other businesses, but basically in a targeted way, looking at restaurants that were eligible to get aid during the coronavirus when funds were made available, and then those funds ran out, and a significant number of restaurants that were eligible for aid did not get them. There has been a little pushback from conservatives saying that obviously this is not an economy that needs a stimulus package, so there's going to need to be a conversation about how to pay for this, whether it is redirecting previously appropriated dollars, whether they can rely on states and local governments to take action. But at least in some way there is a conversation happening on a bipartisan basis about a bill either in January or February that could provide billions of dollars to restaurants that were eligible but didn't get that money.
Yeah, clearly a sector that's been beaten up in many parts of the world, Jack, but interesting to put that in the context of whether the economy itself as a whole needs stimulus. Jack Fitzpatrick of Bloomberg Government, thanks very much for the update. Now, Russia is sending troops to Kazakhstan to quell anti-government protests there that have led the central bank to temporarily halt financial market operations. Protesters are angered by rising fuel prices and are calling for greater democracy in the country. Gregory White, Bloomberg Enterprise editor, joins us now from Moscow with more. Gregory, good to get your update here. What is the view from Moscow then? We understand Russian troops are on their way to Kazakhstan, or are soon to be. What is the view from Moscow of what is taking place on its border?
Good morning. This is a really important test for Russia's ability to assert its control in the region. Kazakhstan's a key ally for Russia, and they've used this treaty organization to send military assistance to shore up the government there. Over the years, Russia's repeatedly said that accused outsiders of trying to foment rebellions in countries around its neighborhood. And this is the most aggressive move yet by the Kremlin to push back against that.
All right, Gregory, thanks so much for the roundup there. That's Bloomberg's Gregory White. And I want to dig into stocks moving pre-market, and one that is moving off of these protests in Kazakhstan. Kazakhstan is one of the biggest producers of uranium, about 40% of the world's supply, because of the unrest, because of the restrictions when it comes to travel and other movements. We are seeing uranium prices move markedly higher this morning. So Uranium Energy Corp, which is a U.S. listed energy stock, pre-market moving 4.5%. We're also monitoring the fallout from some of the stocks that were hard hit yesterday. A lot of the retail favorites, those really richly priced ones, were hit hard. GameStop, for example, falling more than 10%. All of the meme stock basket, as tracked by Bloomberg, was trading at its January low yesterday. We are seeing some dip buying coming into the fore today. GameStop up 2.2% pre-market. AMC, Bed Bath & Beyond, all those types of equities also higher pre-market. Bitcoin, though, that has not seen dip buying, at least so far. We're looking at Bitcoin below $43,000. So Marathon Digital, another Bitcoin stock, falling as well, pre-market down nearly 3%, Anna.
Yeah, whether the meme stock a phenomenon as the Fed tightens policy or gets ready to. We'll certainly consider that. Coming up on the program, Nina Skero, Center for Economic and Business Research CEO. We'll get her perspective on the Fed minutes. What did she take away from them? Has it changed her thinking on March as a live meeting for the Fed? And 1 year since the attack on the U.S. Capitol, we'll discuss what's changed and what has not changed in U.S. politics with Leslie Vinjamuri, Chatham House head of U.S. and the Americas program. Plus, Jeff Curry says commodities are the best place to be right now. More from our interview. That's coming up ahead. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. Now, it is rare that FOMC minutes can really surprise the market, but yesterday we certainly got a dose of that. A Fed that is not only more willing to quicken the rate hiking path, but also looking at a balance sheet runoff as well. The real bulk of the reaction, at least in terms of what caught the market's eye, was the movement in real rates. I want to welcome our radio listening audience as well, because I have a chart up in front of me. Let me describe it to you. I'm looking at 5-year, 10-year, and 30 real yields. all of them together moving higher yesterday. It was led by the long end, but we've seen this play out before. Last spring, we certainly had real yields moving higher as well, and that was eventually undone. I want to bring in Ven Ram, currency and rate strategist at Bloomberg MLive. Ven, good morning to you. So how much staying power this time around does it look like the climb higher in real rates has?
Morning, Dunny. You're absolutely right to bring up the parallels with spring, what happened in spring last year. I do think, however, this time it's going to be different. Why is it going to be different? It's going to be different because last year we saw nominal surge and inflation-linked bond surge. But this year, I don't think inflation-linked bonds are going to surge as much. I'm not saying inflation pressures are going to ebb. They're going to be consistent. They're going to be protracted. But they're not going to run up as much as they did last year. But nominal yields are going to surge this year, particularly at the front and intermediate end of the curve. And that means that real rates are going to be unlocked and unlocked higher. And that really is going to be the narrative of 2022. That's going to drive valuations on stocks. That's going to drive valuations on currencies. And that's really the story of this year.
OK, and what's that going to do to the dollar then? Good morning to you, Ven. What will that do to the dollar? Because some people have said this is the year where other parts of the world catch up with some of the hawkishness of the Fed. But then given what we've seen and the big market adjustments to more hawkishness on the US conversation, perhaps the dollar has further to run. So which side do you fall down on?
Morning, Anna. I think that the dollar absolutely has got legs. We saw what happened last year. The dollar had its best year in so many years. This year, it's going to be a repeat and rinse process, but albeit the gains are going to be a lot more measured. I think that the dollar has got phenomenal upside against the euro, the Swedish krona, and the yen, more measured against the yen rather. And that, why do I say that? Because again, real yield differentials are going to come into play. Real yield differentials are going to move in favor of the dollar against these currencies, which means that we are going to see a pronounced advance of strengthening of the dollar against these currencies.
And obviously, we saw the dollar at its strongest relative to the yen going back to 2017 earlier this week, even though that has reversed a little bit. When I want to come back to the rates part of the conversation, though, talking about higher real yields this year, how high are we talking about? Because they're still negative 85 basis points, even with the move that we've seen so far.
That's a great question, Kailey. I do think that, real yields may go up anywhere between 30 and 50 basis points this year. They will still be negative by the end of the year, but I do think that maybe there is scope for 30 to 50 basis points of higher real yields. And that is predicated on the Fed's moves. If the Fed moves 3 times this year, I think probably 30 basis points. If they move a lot more aggressively, and particularly the bit that they said about the balance sheet runoff being the main policy tool last night, which I don't think got as much attention as it deserves to. I think if they embark on that proper, I think that we will see about 50 basis points of higher real yields, both at the 5-year end of the spectrum and the 10-year end of the spectrum.
OK, we'll keep the balance sheet front of mind then, Ven. Thank you very much, Ven Ram, currency and rate strategist at Bloomberg MLive. And you can get further market analysis and updates from the Markets Live team. MLive Go is the function to use on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. Now let's get your first word news updates. Around the globe, governments are taking more steps to slow the spread of the Omicron variant. Japan has raised its threat level. It also urged the US to impose restrictions of troops stationed in the country. Meanwhile, China advised people to avoid long-distance trips during the upcoming Lunar New Year holidays. It also introduced new restrictions for people traveling from the United States. In Chicago, public school classes have been cancelled for a second day in that dispute involving the teachers' union. Teachers voted to shift to remote learning, and the school district called it an illegal strike. The union and school officials can't agree on issues such as COVID testing. In the UK, there's more evidence that inflation is eating into confidence across the economy. More British businesses than ever before are worried about inflation, and a record number plan to increase their own prices. That is according to a survey by the British Chambers of Commerce. And in Australia, tennis star Novak Djokovic remains in a hotel while his lawyers try to overturn the decision to deport him. Federal officials overruled a state vaccine exemption for Djokovic that led to a national uproar. He's in Melbourne for the Australian Open tournament. And of course, the big question, Kailey, is how long will he be there? Will he be returned home very soon? No surprise that this became so politically charged in a nation that had such tough quarantine measures, kept its own fellow Australians out of the country so effectively for such a long time as it tried to fight the COVID virus. No surprise then that there's little political capital in backing an international tennis star over such anger at home.
Yeah, I think we have to keep in mind we're talking about a very high-profile person here, a world-renowned athlete. I love the quote from Scott Morrison, who said there's no special circumstances here. The rules are what they are. So it just goes to show you, even being one of the best tennis players in the world isn't enough to get you around COVID-related rules.
Although it wasn't just Scott Morrison getting involved, politics also from Serbia. The Serbian president also got involved, saying that Djokovic needs to be moved from what he called this infamous hotel. Associated Press just saying that this is the hotel that's the detention center for asylum seekers. Also suffered a fire 2 weeks ago. So conditions also concern everybody's getting involved. Everyone's prime minister and president. All right, well, we're going to move away from the sports talk next. Get back to the economy. We talk to Nina Skero next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. And Kailey, as we are, 2.5 hours into the European trading session here, European equity markets continue to be on the back foot, reacting really, getting global reaction to what Wall Street reacted to yesterday. And that is, of course, the Fed minutes. More hawkish, more hawks on the Fed than have been anticipated, perhaps. That puts March firmly and squarely in focus. But as we were hearing from Vinjamuri, also very much focused on the balance sheet and the use of the balance sheet as policy gets a bit tighter in the United States.
Yeah, I think that's really what spooked the markets yesterday, because obviously we knew the outcome of the December meeting already. It was the language around the potential running off of the balance sheet, and maybe an earlier liftoff than expected that I think took markets a little bit by surprise. And I think that's going to put the payrolls data tomorrow at 8:30 a.m. Eastern time here in the U.S. really in focus, because if we get a strong print like we saw the upside surprise on the ADP report yesterday, is that actually a negative for the market, because it reinforces the idea that the Fed is going to move earlier than we all thought?
Absolutely. And as we look at US futures then, Danny, they look a little more positive, a bit more optimistic. So as we turn from one trading day into another stateside, things look a little bit more positive. Nasdaq futures down 0.1%.
Yeah, today might be more about being discriminate in this market, not necessarily a sell everything, you can't find safety, but maybe this is the day where you pick some of the winners that might come out if we do have this rotationary trade out of value. When it comes to the bond market, it still is exerting this bear flattening. We see 10-year yields higher by about 2.5 basis points at 173. The front end of the curve, though, is moving more. Is this potentially a policy mistake? Is there going to be weak economic growth? Is that why we're seeing the flattening? You do see real yields, though, continue their upward march, now higher by a basis point, still deeply negative, however, a negative 84 basis points. Now, the dollar, just in the few minutes, is something Kailey actually flagged to us during the break, turned negative, a weaker dollar. Part of the G10 space that's moving the dollar lower is a bid into the yen up by 0.2%. That haven bid, despite the fact that we have seen a lot of pressure on this haven currency over the past month or so. European stocks, a little bit of catch up here, down about 0.9%, despite many analysts, Goldman included, saying that Europe should benefit in a higher yield environment. Let's get your check on the U.S. stocks that were the biggest losers yesterday. So Microsoft, Apple, Tesla, and Nvidia in that order exerted the most downforce on the S&P 500 in terms of points. Most of them negative. Apple and Tesla still down. Tesla pretty significantly, almost 1%. Microsoft, however, is little changed. Nvidia moving higher this morning, up 0.7%. Nvidia did say that they see the chip crunch easing. So it's not this indiscriminate selling of tech again. There is some variety. Now, as we've been talking about, what really caused the sell-off in these longer duration assets was, of course, the FOMC minutes yesterday. So I want to dive into the charts start, for our radio listening audience, I am looking at U.S. financial conditions. When they're positive, it means that they are looser. Negative, so in the red, means that they are tighter. So again, for a radio listening audience, they have been extremely loose for much of the past year. Yesterday, the Fed talks about tightening financial conditions through a balance sheet runoff. Now, we do see a little bit of tightening in conditions, but still, on the grand scheme of things, they are still significantly loose compared to the historical average. Well, let's bring in Nina Skero, Center for Economic and Business Research CEO. Nina, thanks for joining us. So a balance sheet runoff, is that enough to bring about tighter financial conditions?
Well, we've seen some messaging in that direction from the minutes released earlier. There was some suggestions that there would be a rate rise coming in the spring, which shouldn't have come as a surprise. The Fed has been messaging in that direction for some time now. We have seen probably a more hawkish tone than some would have expected. And I know some commentators were left asking the question, what about the Omicron variant? Shouldn't that be accounted for somehow in these minutes? Isn't that going to change the narrative? And we don't have any more concrete messaging that's been more recent than the minutes released yesterday. So I think that is now one question mark. Since those conversations took place some weeks ago, has the Fed's thinking changed as a result of the new record infections? And all of this is contributing to a bit of a complex picture looking ahead to the non-farm payrolls tomorrow.
Nina, good morning. It's interesting. I spoke to one guest earlier on Bloomberg Radio who was saying that away from the actual details of what the Fed said, it was interesting to her that we seem to have a more nimble Fed. The tone of the minutes suggested a Fed that was more, to your point about Omicron, more able and willing to react to news as it develops, given that we've come through a period where the Fed was setting some fairly long-term guidance, or at least medium-term guidance to markets for where they were heading next. Is that something we need to brace ourselves for, and volatility attached to that?
Well, there is volatility attached to the current conditions because the situation is quite rapidly changing on many fronts. And if anything, a Fed that is willing to recognize that and respond to it is probably something to be optimistic about. I think speaking of volatility, something that we need to keep in mind, again, thinking of the non-farm payrolls and the labor market data tomorrow, is that the revisions we've seen from first estimates to later adjustments in the official data have been quite significant throughout 2021. And that's something certainly that's going to be a factor for the December figures as well. And what I would like to see both from policymakers and commentators and probably market participants as well is that recognition that there isn't as much certainty when you see that first estimate of job data, for example, that's going to be very similar to the final estimate.
Yeah. And Nina, does that downplay the importance of the jobs data at a time when perhaps it was already slightly less to the fore for investors because the Fed has made it clear it's focused on inflation? It doesn't necessarily, or some of the Fed officials don't necessarily need to see full employment before we can start hiking rates.
I would say that you could say that it should downplay the importance of the initial estimate, but we haven't seen that it's actually done that. There is still very much focus on the numbers. There is a little bit of contradiction there, as you mentioned in the program earlier, that a very strong figure tomorrow. So I believe the consensus expectations are around 400,000 for the non-farm payrolls. I actually think it could come in higher than that, at closer to 500,000. But I think if it goes well beyond that, as you said, that strong number could, in a bit of a contradiction, actually have a negative impact on markets, as it would signal an earlier and more persistent monetary policy tightening throughout 2022. But to your question, no, perhaps the fact that there has been significant revisions to data should temper reactions to any data releases, but we just haven't seen that.
But talking about the data, obviously there are signs that the labor market is quite tight. We saw that in 4.5 million people quitting their jobs in data earlier this week. Then we had that ADP report that was essentially double what economists were expecting. And yet participation is still very, very low. Are we just now looking at a structurally lower participation rate here in the U.S.?
We've been trying to answer that question ourselves, and it is a tricky one. There do seem some people that have just dropped out of the statistics throughout the pandemic. And it is difficult to say what they have done. Perhaps some of them are still looking for a career change or are starting their own ventures, which aren't quite being picked up in the statistics in the same way. So is there going to be a return to the pre-pandemic structure of the labor market? Perhaps in the very longer term, but you are probably right to say that at least in the next sort of 2 to 5 year horizon, we probably need to slightly forget what the pre-pandemic norms were and do more thinking on what the new normal is looking like.
And, we've spent most of the show today talking about the Fed and when the Fed is going to move. Of course, on the other side of the Atlantic from where I am in the UK, the BOE already has moved. What is your expectation for their rate hiking cycle moving forward, considering the labor and inflation dynamics there?
So we are expecting 2 more moves by the Bank of England this year, one in the spring and one in late summer. And as you said, they've been faster to move than the Fed, certainly than the ECB. I think there's going to be a little bit more of catch up there between the Fed actions and the Bank of England, and that basically a slow but steady tightening is going to be the name of the game for both of those central banks in 2022.
Nina, thanks so much. Good to speak to you. Nina Skero, Centre for Economic and Business Research, where she is the CEO. Good to get her perspective on the Fed and the broader policy dilemmas facing central banks as we go through 2022. We'll get back to the politics shortly. Coming up, Leslie Vinjamuri will join us, Chatham House head of US and the Americas program. We understand that President Biden is going to be quite scathing in his criticism of President Trump and his role 1 year ago on Capitol Hill. We will talk about that next, what to expect from 1 year on from January 6th. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Council on Foreign Relations President Richard Haass. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Kailey Leinz in New York. Matt Miller is off today. Now, President Joe Biden and fellow Democrats are planning events today to commemorate the first anniversary of the Capitol Hill attacks. This comes as the country heads into midterm elections that will decide control of Congress. Joining us now is Leslie Vinjamuri, Chatham House head of U.S. and America's program. Leslie, good morning. It is hard to believe that it's a year on from January 6th. How would you, at this point, 12 months later, describe the characteristics of a polarized U.S. political system?
Well, you've certainly nailed it. America is, as we know, deeply divided. It is polarized. And to look back 1 year ago today, when we were, so many of us, perhaps we shouldn't have been, what we were certainly caught by surprise when we saw what happened at the Capitol. I think what's been even more surprising in the short term was that moment wasn't captured as we thought it might initially be, to bring Americans together, to condemn the violence, to condemn this kind of action, and to really come together. And there was a moment when I think people thought there would be. We saw Kevin McCarthy even saying that this wasn't the right thing. And very quickly what we've seen is attitudes amongst Republicans and Democrats in Congress, but certainly across the American public, really divide. That's been reflected in efforts to hold individuals accountable. We saw, of course, that there was a block on the effort to have a 9/11 style commission. The House investigations are seen by Republicans as being very partisan and very political. And today, as Americans look back, of course, there will be commemorations, but the Republicans will be off in another spot telling a very different story that really capitalizes on that big lie that many Americans, many Republican voters still think has a degree of credibility. Right. And that really is what's at the heart of all of this. Do you believe that the election was legitimate or that it was irregular?
Well, if both sides of the aisle haven't come together, Democrats, at least for today, are hoping that they can bring their own party together and get something through like voting rights legislation. Does this type of strategy on an anniversary of January 6th, is that likely to have any staying power?
Well, I think that, this is where the battle needs to be fought, is making sure, A, that you get those laws in place that allow for national standards on voting, whether it's mail-in, whether it's early voting, that make voting possible for larger numbers of people. But of course, it's deeply political. We're seeing this fought out on a state-by-state level, with many Republicans fighting to restrict voting, and obviously the Democrats looking to do something very different. And it becomes important in the run-up to the midterms, and certainly in the run-up to the 2024 elections. But again, if you look at the polling from the Washington Post, University of Maryland poll that came out very recently, it suggests that there really is a very deep divide of whether people believe that there's a problem with voting and what the source of that is. And so long as you have that deep division at the popular level, it's manifest in Congress, it becomes, as we're seeing, very difficult to get that legislation through. And it might, of course, the threat is that Democrats will take on the entire question of a filibuster. Is today the day for it? I think it's inevitable, because that is really what January 6th was about. If you believed in the big lie, you believed that you were legitimately protesting an election that had been stolen.
Well, Leslie, we know when President Biden speaks around 9 a.m. Eastern time, he is going to make the case for voting rights legislation. He also is going to be quite sharp in his criticism of former President Trump. And we know Trump himself was going to speak today. He isn't anymore. But as we look now on January 6, 2022, how much of a grip does Trump still have on the Republican base and therefore the Republican Party?
Well, it's extraordinary, the extent to which Donald Trump is still the influencer in the Republican Party. He's already put his own backing. He's endorsed 100 candidates in the midterms. I think that seemed to be very important for Republicans in the primaries. There is a question about whether that could hurt some Republican candidates when you go to a general election, certainly in swing constituencies. Plenty of Republicans don't want to see Trump have the influence that he's had, but speaking out and saying that is very difficult. One poll said that more than 60% of Republicans do not wish to hear a bad word said about Donald Trump, while only 24% would actually like to see him in office again. So there's a big gap, and it's a very difficult politics. The decision by Donald Trump not to speak suggests that he understands that he has this enormous influence, but there's also potential, especially on a day like today, for a very significant backlash if he's seen to induce violence.
Leslie, what is the role of Representative Liz Cheney here? She's been somebody who, from within the Republican Party, has been pretty critical of former President Trump. And some of what she's been saying is happening behind closed doors in this House committee. They've been doing their investigations. What more are we going to see from her? What role will she have in the year ahead?
Well, I think Liz Cheney's an extraordinary figure because, of course, for a long time she was seen to be very far to the right. Now I think she's a Republican that, for many moderates on both sides of the aisle, is a potential leader in the future. But at the moment, of course, she's in a very difficult place with her own party, and that's a tough line to follow. Whether she will emerge in time, we will have to wait and see. But at the moment, certainly, she's in a tremendously difficult political position. But we are all watching. This is the #1 question for American politics. Will there be the prospect of a moderate wing in the Republican Party that in time comes to have more influence? It certainly doesn't look that way right now.
Leslie, finally, we've talked a lot about the internal view of American politics. What about the external view? What is the foreign perception of American democracy that, when elections are called into question, very much looks eroded?
I think that people are stunned and shocked. I think for some leaders in more autocratic states, authoritarian states, China, Russia, this plays into a narrative that they're seeking to portray to their people that, democracy isn't as nice as America would like to say it is, and it doesn't work so well, and it's certainly not working so well right now. I think for Europeans, there's a degree of still shock, even a year on and several years on from Donald Trump's original election, at some of the attempts to undercut things that we thought were very consolidated in America's democracy. But now I think there's a conversation that's beginning about, what should the UK do? What should Europe do? Should Donald Trump return to power? Should he pursue, or somebody, it's not even necessarily a case of Donald Trump. It's whether Trumpism, whether that's the kind of candidate that will emerge, and what will that mean for Europe? And should Europe take steps to hedge against that, to safeguard against what might be a very intermittent commitment on the part of the United States to Europe's future?
Yes, it was certainly the election of President Trump that took Europe by surprise. They don't want to be caught off guard once again. Leslie, thank you very much. Leslie Vinjamuri, Chatham House head of US and the Americas program. And later today, we'll speak with Democratic Representative Dan Kildee from Michigan. That is at 12:30 p.m. in New York, 5:30 p.m. in London, as we remember a year since members of Congress were forced to cower beneath their chairs. Staffers barricaded themselves into offices on January 6th. This is Bloomberg.
Extremely bullish on commodities and real assets, broadly. And I think you look at the setup we have going into this year. You've got equities, stretched valuations, the convexity at bonds, at a very, very high level. You have record dislocations in energy markets, metals markets, agriculture markets, and you still have a lot of money in the system. And then finally, you look at the investment positions in commodities, it's very low. What does that tell you? The best place to be right now, particularly given the Fed pivot, are commodities.
Goldman Sachs Global Head of Commodities Jeff Currie speaking to Bloomberg earlier. Now let's take a look at what else we're watching today. And I am watching Novak Djokovic to see whether he is ever able to leave his hotel room in Australia where he is being held. He currently has his visa revoked to get into Australia. He was there to play in a tournament. It was revoked because he didn't have the necessary material to show he had a medical exemption for vaccine criteria. Everybody's gotten involved, from Scott Morrison of Australia to the Serbian Prime Minister. Kailey, how much longer is he going to have to wait, and will he be able to go for another title?
We should get a bet going, and whoever's closest to the actual amount of time wins. I think we're all watching that, Danny. I also, unfortunately, have to keep my eye on markets and the economy, and I will be watching the economic data here in the U.S. We get jobless claims at 8:30 a.m. Eastern Time, expecting another print sub 200,000. Of course, every read on the labor market is important, especially in the drumbeat to tomorrow's December non-farm payrolls report. And then at 10 a.m. Eastern Time, we get ISM services data. And I think that will be really interesting as well, because, of course, we saw a record on that in November. We are expecting it to come in just a touch, but still a 67 print is what economists are looking for. My question is, how much has the current outbreak of COVID affected the services industry? And of course, any read we get on inflation on that front, Anna, also will be something I pay attention to.
Yeah, absolutely. We'll hear from James Bullard as well of the Fed, St. Louis Fed. He'll be speaking. That's something to watch or to work into the market narrative today. Interesting on the Djokovic front. One of our colleagues writing an opinion piece calling it Djokovic's double fault in the Australian Open, which is certainly worth a read. I'm watching the COVID phenomenon more broadly, and certainly here in Europe. We've seen the Asian story, of course, in the last 24 hours or so. We've seen further rules being introduced in Hong Kong, in Japan and China. The European narrative is very much around the unvaccinated. The French president saying he wants to make life more difficult for the unvaccinated. We saw record cases on Wednesday, 332,000 in one day. Supersonic wave warnings coming out of France. And in Italy, they are mandating vaccines for the over 50s and really reducing the amount of freedom that those who have not been vaccinated will have in Italy. So we're certainly watching that as a growing phenomenon across Europe. Now, more Bloomberg surveillance is ahead. We'll hear from Seema Shah of Principal Global Investors and Leland Miller, China Beige Book CEO, among others. This is Bloomberg.